let's move on. But we'll be still talking about fixed income instruments. The yield on the benchmark 10-year government bond has fallen below 7%. Now, this takes the 10-year bond yield at its lowest level since March 2022. What does this mean for the markets, investors, and more importantly, how will it impact your debt portfolio? Let's understand all of this. I have Vijendra Srivastava, CIO, Fixed Income, Sundaram Mutual Fund. Vijendra, hi, good evening, and welcome to the Money Show. First question to you. Do you see the bond yields going below 6.9 and then maybe there'll be a range-bound movement? What is your analysis on the yield movement for maybe one more quarter?
Yeah, so I think it can go there. Technically, we can see 6.80% coming on the 10-year benchmark. Primarily, it is because of the fact that we have set a high base last year on inflation, and people will look at it. Despite the seasonality in the current inflation number, we saw 0.5% sequential momentum. And at the headline number, it was a little below what the market was expecting. I think couple of more inflation numbers will be impacted by the base, and you would see the headline number being lower than what the RBI has forecasted. So I think that can play on the minds of the investors, and you could see a sequential momentum building up on the yield front and the bond portfolios. Basically, the investors, the traders would build up their positions. Already, I think the market is loaded up on bonds in general. I think that's what we are reading into the market as of now. And what can happen is also the global environment. So we are seeing weakness in the growth numbers globally. That could also play on the minds of the domestic bond investors.
Vijendra, I want to understand this entire situation with the backdrop of poor monsoon. That is what we are hearing and estimating. We had SkyMet, we had IMD also coming up saying that there will be a late entry of monsoon this time, and we will not be seeing a usual or a normal monsoon. Now, if this situation really gets severe, what are we looking at? Inflation going up again, and so far it is below the upper limit of RBI and comfortably below the upper limit of RBI, and then we might also see the pause for the rate hike extending. But do you think monsoon is something that is going to be a major trigger now going ahead?
To answer that, I think we have to look at our CPI inflation. It is heavily weighted towards food and fuel. Okay, and 50% is food and fuel. And because of that, in case any vegetable inflation and fruit inflation comes in, right now what we have been seeing is the protein inflation in CPI basket. And if any food inflation comes back in terms of vegetable and fruit inflation, I think that will cause the headline to move higher than what is anticipated. So that is something which we have to bear in mind, and market is also definitely looking at the core. Right now, the trigger for the bond market has been largely the pause by RBI, and the other thing is that core momentum also has slowed down. If you look at the core from about 5.8, 5.9, however you read it, it has come down to 5.1 to 5.2%. And a poor monsoon, if it plays out, will have an impact on the food prices, and that could stop the bond rally. Also, the other thing which market will probably look at is the kind of supply we are witnessing from the government. In case the growth slows down and any deviation in terms of the borrowing, that could also play on the minds of the bond. So these are the kind of caveats which we have to build into our buying of bonds or long bonds rather.
Vijay, do you think the last 6 months of the year we might just see rate cuts happening, or you think the pause is going to extend longer than expected?
See, we think that slowdown has started, particularly on the global front. We started our rate hikes because of Federal Reserve, okay, the developed nation. We were not in, our central bank was in no mood to raise rates. It was primarily because whether we accept it or not, it was primarily because of the global environment we started raising rates. And I think that will again play out. The playbook will be in the same sense. We will probably see the central bank cutting rates when they get a leeway in terms of the global environment. So what happens in the US, we have to be very critical in that space. We have to see how they progress. If there is an extended pause in the overseas markets, I think we will also see extended pause. But there is a good chance that the Indian Central Bank will probably try to uh, front run the overseas central banks. That's what we can understand at this point in time. So I think answer is very difficult to say at this point in time that whether there will be extended pause or not. But inflationary momentum is quite strong, and we have to bear that in mind while building up any rate cut cycle. We think that even if a rate cut cycle happens, which will be again in line or in phase with the global central bank, we think it will be a shallow rate cut cycle. That's what our belief is.
So is this the time to park in money for medium to long term? Looking at the interest rate scenario now, what do you think? What should be the strategy?
So I see what we have seen over the years that the capture of the investor on the long bond side is very low because of the simple reason that the liquidity on the long bond suddenly vanishes. So what we suggest is that if you want to really capture the interest rate movement, better be on the medium duration product. We believe that probably the yield movement will be there, and already we have seen some 40 basis point down move on the 10-year bond yield. And I think further another 30-40 basis point move could happen depending on what the momentum is there in the future. But I think it's better if you're not a very savvy investor, be stick to the medium duration product where ample liquidity is available and exit is also available on a daily basis. And the yield movement is not very discrete; it's more continuous in nature.
All right. What kind of fixed income options would you recommend to our viewers?
So I just told that I think we think that medium duration buckets are good. So and particularly see in light of the uh, indexation benefit being taken away, what we also see that the competition of the mutual fund industry is not there on the longer bond. If you look at the banking industry offers very attractive yields in the shorter tenors. They don't offer. So if somebody is looking for very long tenor, long term investment and fixed income as an option, they should look at very long tenor investments on the mutual fund platform. The expense ratios are very competitive, and the target maturity funds offer very attractive yield and a consistent yield over a period of time. So they give you visibility of return for a very long tenor. So that's the reason why we say that if you are a very long term investor, you put your money in these target maturity fund, index funds, and very constant maturity funds, kind of funds which you can put. While if you are a tactical investor, you are looking at fixed income for a 12 to 24-month kind of horizon. I think either match your duration if you're a risk averse investor, or you put money in medium duration products, depending on how you are looking at the market.
Duration product if you're looking at something in fixed income. Thank you so much, Vijendra, for being on the show and helping our viewers with their fixed income
Right.
portfolio today.